Hello, everybody. Hope you're having an amazing day in the stock market. We hit new all-time highs yesterday. I know there's a bit of a pullback today, but pullbacks are just opportunities in the eyes of the long-term investor and the smart investor. But today we are going to be switching lanes a little bit and talking about some of these new ETFs that are breaking onto the scene, specifically a kind of ETF that I had never heard of before. Now, this was surprising to me because I largely deal with ETFs on a day-to-day basis. If you talk to me about leveraged ETFs, if you talk to me about thematic ETFs, income ETFs, I've seen the full gamut. However, I had not seen this new ETF that Leverage Shares just put out. And so to me, this was something that was really interesting. We're going to share a little bit of information before I get into this, especially with these new styles of ETFs and different things. I think it's pretty important to throw in an important disclosure right here that ultimately these live streams that we're doing together with our amazing partners over at Leverage Shares are paid advertisements, right, for these ETFs, and that these are intended for informational purposes. Please don't say, hey, I heard them talk about this on a live stream. I'm going to go buy this, right? Instead, use this as an opportunity to begin your due diligence. We don't make recommendations or endorsements of any specific ETF stocks or strategies. Rather, we explore the due diligence behind them. Investing has the possibility involves risk, including the possibility of losing your principal. So please take the time to do your due diligence. And if you feel the need to, consult a licensed financial advisor. With that being said, let's dive into it and get a true understanding of what is going on inside of these ETFs. This is a 2x capped accelerated monthly ETF. Several of them were dropped. I just posted the tickers as well. They are on my page for people to see inside of this live stream: NVDO, PLOO, COIO, MSOO, and TSLO. We have with us, very lucky today, Paul Marino, the Chief Revenue Officer from Themes ETFs. Of course, you're intertwined with Leverage Shares. Can you talk with us a little bit about how these ETFs work, what the upside is, the downside, and how you came up with them?
Yeah, sure. So the reason we came up with them is our portfolio management team has a lot of experience in trading options at prior places. And what we're finding is, Leverage Shares started in Europe in 2017 as a pioneer in the in the leveraged ETP space, single stock leveraged ETPs plus baskets. And so when we started launching leveraged ETFs in the United States in December of 2024, we realized there was an appetite for them in the United States, and we've done really, really well with them. But also there's a lot of risks associated with when you're leveraged to the upside and you're using swaps to get the exposure to it. You're 2 times up and you're 2 times down. So we heard from investors that they would love to be able to get some kind of accelerated capture on the upside with a little bit of protection on the downside. And so if you're a very experienced options person, you know how to do this on your own. You can create this strategy on your own. But we deal with a lot of retail investors because of the ETF wrapper. And so we used our expertise from our portfolio management team to create an options-like strategy that's inside of an ETF wrapper. And that's what these capped accelerated funds are. So if you think about like a structured note, right? Essentially, you're trying to capture amplified returns on the upside, right, to a cap. And the reason why it's capped is because you're getting protection on the downside. So the protection on the downside, what you could consider a buffer, is that you're only getting one time on the downside with an accelerated opportunity to the upside. And that's essentially what they are in an ETF wrapper. The way that we designed them was point to point on a calendar month. So we set our cap rates on the last business day of the month for the new month, and then you can make your decision whether or not you want to get into the ETF. Important to note, though, that they still are daily liquid. So on a day-to-day basis on the company website, if you go to a particular strategy, you could see what it's doing, what the options are doing, what they're earning you on a day-to-day basis, and you can make your decisions whether or not you want to stay in them or get out of them. But to receive the full buffer capacity, you have to stay in, on the calendar month. And then if you choose to stay in, it just rolls over into the new cap rate, which will be posted again on the last business day of the month.
Great. And so to take some of those words and maybe try to simplify them a little bit, when you're investing in one of these ETFs, provided that you get in on the day, right, where the strategy is initiated for the month and you hold for that month, you have 2x upside on that, stock up until a specific cap
Yep.
that gets hit. And on the downside, you have 1x downside uncapped.
Yes. Yeah, precisely right. You can get into them in the middle of the month, and we'll show you what that targeted cap would be from the point that you get into it. So again, we just like you said at the beginning of the show, we recommend before trading into these, go to the website, check out where the cap rates are, and make a determination of whether or not you want to get into it.
Can we get a little bit further into that? So the starting point is first business day of the month.
Yeah, and for this rollout, obviously, we're not at the first business day. We just launched these on August 13th, so it's not a full month for the launch. But we do have on the website what the stated caps are, and I can provide them. I have them written down here. What the target caps are for the remainder of the month.
Yeah, I'm curious because I want to have an understanding. So maybe we can pick, one of these stocks, NVDO to start with, and get an understanding of, hey, right now, and NVDO, for those that want to pull it up, following with us, is trading right now at $19.82, right? And NVIDIA on the day at this moment is up about, it's basically flat. It's up about a few cents right now. So pretty flat on the day. And so this is kind of mirroring it right now. It's pretty flat on the day as well. It's up about 3 cents. So walk me through like what this is going to look like if NVIDIA jumps 5% tomorrow, right? Different scenarios.
Yeah. So right now, the targeted cap for the remainder of the month is 8.99%. So what that means is you have the ability to get accelerated returns for the rest of the month up into that stated cap. So let's say tomorrow. Oh, sure.
Sorry on that. So if it's 2x, it's not like it's 2x the 8% of the underlying move. So if we're talking about the NVIDIA one, it's an 8% NVIDIA move. So that'd be like 16%, or is it 8% on like the 2x?
No, so I'll explain it to you really fully with this. So right now you're at 8.99%. So let's just say, round it up to 9%. So let's say NVIDIA makes a move tomorrow of 2%. What we're shooting for is a 4% gain in the return. Oop, I think I just lost you. Am I back? I think I lost you for a second. Yeah. So you're looking for a 4%. You'll get approximately a 4% gain in the stock, okay, in the ETF, okay. But let's say NVIDIA goes up 10%. You're going to be capped out at 9, okay. Because like we're giving you the accelerated return up to a cap. It works like a structured note. Okay, so right now, if you're in the middle of the month and you're thinking, NVIDIA earnings are coming out in a couple of weeks, I want the full breadth of that. We have NVDG, which is a 2 times levered ETF, and if you really think it's going to explode up and you're not worried about the downside, that's something that you could get in, and you would get the full acceleration of that. But if you're worried around earnings and you're concerned and you want to put some risk mitigation in, we'll still give you amplified return of whatever NVDA does, whatever NVIDIA does, up until that cap. But once you go past that cap, you're limited to that cap.
Yeah, that makes sense. What, I guess, let's say it goes up past the cap. Does that mean that, hey, let's say it's 8.99, right, for the rest of this month. Let's say NVIDIA surges. And this would basically say the underlying NVIDIA goes up 5%, right? So that this, at double leverage, would have gone up 10%, but I'm getting capped at 8.99.
Yep,
correct?
Exactly. Yep.
If NVIDIA then falls 0.5%, so now I would have been up 9, do I see downside happen within this ETF? Is it like, how does it work on the back end?
Yeah. So, well, the way that you're going to experience loss is one time down, right? So if NVIDIA, so let's just use round numbers. If NVIDIA is up 6% at the end of the month, right? Or getting towards the end of the month, let's say the day before the last day, it's up 6%. You're going to get 8.99. But let's say in the final day of trading for the month, it goes down 1%. So it goes to 5, you'll still get 8.99.
Got it.
Yeah.
Okay. So I hear what you're saying about if you have, that full confidence, you're not worried about earnings. Here's a longer term strategy. We're talking about this halfway through the month. So would it be correct to extrapolate out and say right now 8.99 is for half the month? A typical month would be, 9% times 2 and be 18%, or is it just going to be different every month?
Yeah, I mean the cap is going to be different every month, and it's based on the volatility of the underlying stock, just like any other options contracts are. So the more volatile the stock, the higher the possibility for a higher cap rate. When we back tested it, there were certain months where we saw 39% cap rates in underlying stocks like Tesla, NVDO, and the ones that we've talked about here. So you have to make that determination at the beginning of the month how you want to play this. And again, we're not saying that it's there to replace your holdings, but like if you think about it this way, if you're coming into earnings, you already hold the stock and you want to get additional amplified exposure, but you don't want to take on additional risk like you can with our leveraged ETFs. This gives you the opportunity, if you like the cap rate and you think that there's enough of an upside, to potentially get that amplified return on the upside without taking more risk on the downside.
Got it. Okay. So I still have, I guess, a couple of questions off of that piece right there. What are the determining factors of ultimately what that cap is going to be? Is it volatility? Is it
volatility and the options pricing, of course, because the way that these are designed is there's 4 legs to it. So we're taking a synthetic long. We're not actually holding the stock to get the exposure. So what we're doing is we're going long a call on the expiration date, which is the last business day of the month, right? And then we're short a put on that same expiration date. So that gives us the 1-to-1 synthetic coverage on the way down, right? So when you think about how we're getting the amplified exposure, so we're gonna take on at the money call purchases on the roll date, right? So that's what gives us that amplified exposure. And then what we're doing is we're offsetting that by selling options. And depending upon how much that cost us, that's what we sell. So all of that combined, plus the volatility and the pricing of the options, will create the cap rate. And that's why we set it on that very last day at the close, so that we know where we're at, what we price it at, what the volatility is, and what we're going to be able to do. And then we can state that cap rate for the following month period. And then again, you make the determination about whether or not you think that's, that risk reward is worth it for you.
Could this be done? Sorry, go for it. Yeah.
I was going to ask, so I'm looking at the TSLO one, and I'm looking at some of the contracts that you guys have here for the 29th. Will those contracts ever change? Like, let's say it's ripping up to the upside and we're at 340 now or something. Sometimes some people I know would maybe roll some positions or anything like that. Will these contracts change throughout the month at all, or are they kind of going to stay there?
No, they're going to stay where they are for the month. It's a point-to-point calendar month option strategy inside of the ETF. They will roll to the next month. So again, at the end of the month, we're going to redo the caps. We're going to redo the options inside of it. And then if you decide to stay in the strategy, you don't sell out of it at the end of the month, you can roll into the next monthly cap.
So are a lot of the moves going to end up happening at that kind of end of the month, start of the month for a lot of them, or is it going to kind of happen throughout the month?
Well, so as Gav said, these are new strategies on single stocks. And so, the experience is yet to be determined. I would imagine that depending upon the movement of the stock and what the stated cap is, you could see people getting into it in the middle of the month. I mean, so let's look at it this way. You have, maybe a down move in Tesla and people are looking to get some additional exposure to it because they already hold it, but they, want to limit their downside risk. And again, they don't want to jump into something that could go down 2 times because they don't know where the bottom is. They could potentially get into it in the middle of the month and then they'll, receive that same cap rate. But, I don't really know. We don't have the experience yet because these are brand new products. They were just launched on the 13th yesterday. And so we're going to gain a lot of experience as we go.
God, I apologize for any background noise from mine, guys. Not sure where it's coming from, but sorry about that.
No worries. Yeah. I don't even hear it. So you're good on my end.
All right. Sounds good. I actually had a question. Could you see this being done in the inverse?
Potentially anything is possible. And if there's demand, if we get, investor demand and people say that they want something like this, For sure. We had a nice piece in Bloomberg yesterday, which was very nice. And they talked about how the evolution of ETFs is not just, simple broad-based exposure anymore. The ETFs are becoming, wrappers for more complicated strategies. So if we believe that there's investor demand, sure, we could do that. And we could do something like that. But right now, it's not in the pipeline for our product development. But if anything's possible, you could do the exact same thing opposite with an option strategy and pull it off.
Who's the team deciding which options go into it on a monthly basis?
So our portfolio management team, and they have a lot of experience. So Calvin Zhang is our head portfolio manager. He's got an extensive background at SIBO and at ProShares, and he's been with us since day one, before we even had any products. So he's a brilliant guy. He's very talented, and he heads up the team. But also we have Kevin Chow, who's also on the team, and we have Paul Berkowiak. They're leading up these strategies.
Got it.
All with extensive experience at option shops, including ProShares.
Okay, that's good to hear. Yeah, because it's going to be complex. I think we already dug a little bit into it, but I'm just curious to get a bit deeper into the actual option strategy. And of course, they're going to be looking at the underlying, delta and theta and gamma and all these different pieces. I suppose, have you talked with them much about what they factor in the most, how they're looking at IV, all these other items?
To be quite honest with you, I have not, but and they're working on this. Like I said, as they're building these things out and back testing it, they're looking at all of those components. And I, as the chief revenue officer of the firm, I rely on their vast experience in managing the strategies, and potentially we could have them on at some point to talk about what that looks like. But I haven't had that full conversation, as you could probably imagine. They've been very busy getting these things to launch and making sure that everything's operating appropriately. So I've been talking to them a little bit less over the past couple of days than I have in the past weeks, just to make sure that they have, all their attention focused on managing the strategies. But again, that could be a follow-up at some point, and we can get you those details and have them on to talk a little bit deeper about how they're operating that on a day-to-day basis.
I'd love to ask a little bit more about what type of I want to ask more about the back testing and when you're going through it, and what type of environments the strategy thrived in. Maybe there's gonna, like we've talked to, there's environments where you want to be in just the 2X's. There's maybe environments where you want to be in nothing. I don't know, but I'm curious, when you were back testing this, how this strategy kind of did throughout everything, and then where it may be overperformed.
Yeah, I mean, again, I think in extreme markets of volatility where the cap rate's high, you have a better opportunity for amplified returns. And then it just matters, it depends on what the stock did during that period. So they went back and looked at several, time periods to see what that would look like. And they determined that, this was a strategy that could do well over time. I don't have any of that data in front of me, so I don't want to talk about it specifically. But in any case, anytime you're building a product, developing a product and putting it to market, you're always going back and looking at those. And that's why I had brought up, because I had talked to Calvin late last week. And we had an inquiry from a reporter who went back and tried to predict the back testing, but he didn't actually use real data. And when we looked at it, you could see that, he was averaging a cap rate of 11%, just off the top of his head. But we were like, that doesn't make any sense, because when Calvin and his team went back and did that, like I said, we saw some months where the cap rate was as high as 39%, 40%. And so when you look at those actual periods and you see what the cap rates actually are, you could see that there's a lot of opportunity for upside. And again, it's just like anything else. You're paying for protection, right? So you're going to limit your upside because you're getting protection on the downside. The most simplest way that I could think about this is just think about a structured note. But this is a little bit different because we're doing it on single stocks, and we're going to offer this structured note on a month-to-month basis without, having one or two clients come to us and saying, hey, could you put this together? We want specific exposure to this. We're going to do it broadly. And again, we pick these stocks because they have a large amount of volatility and they're widely traded stocks in the investment space. And so, when we looked at that back testing, we saw that it was something that we could put together on a regular basis, on a month-to-month basis, and make it attractive for investors, again, that want to have some kind of accelerated return, but limit their downside. And so that's the way that it was looked at. That's the way that it was observed. And in the evolving ETF landscape, we've gotten a lot of great feedback on this launch and a lot of attention. And we're just going to have to see how that plays out. I mean, we're literally just over 24 hours of launching these things. So there's a lot to be learned and a lot to be seen.
Yeah. No, I'm excited to watch them. I'm very curious to see what the start of the months look like, the turnover. That should be a very interesting time for you. Maybe we have to have this conversation again then.
Yeah, no, I
But
think so. Sure.
yeah. So I definitely did what I lost my question.
I do
Yeah,
have one.
I'm curious. I'm curious on more of like institutional versus, financial advisors, where you think you're kind of seeing this product finding its market fit.
I think we're going to see it all over the place, to be honest with you. And it takes a lot of education. So we're going through that education right now. Even when I was, speaking to reporters, like everybody's like super curious as to what they are, what they're called, what terminology you use. Is it a buffer? Is it a floor? Is it this? Is it that? So we're going through like a lot of explanations. And the way that they're being termed now is that it's a buffer. It's a buffered product, even though there's no limit on the buffer. The buffer continues with the price of the stock movement at one times while allowing for the possibility of an accelerated return. So when you think about it in those terms, if your downside risk is only one time the position, we know that retail investors are interested in this, and we believe that there'll be an uptick once we get this out to market and we get exposure on it. But my thought is, if you're only getting one-time downside return, right, then there could be interest from the financial advisor community that at times is looking for amplified returns, but they don't have access to it because the risk on the downside is too great for the platforms that they're working with, whether that be an independent broker dealer or a wirehouse. They won't allow at this point 2 times levered single stocks on their platform. We think this could be an opportunity, since there are other buffered strategies that are on those platforms, to get on those platforms. But again, with all of those platforms, you got to get it out into the marketplace. It's got to get some experience. You've got to get some data, and then you've got to get a return profile. With some of them, it's 6 months and a certain limit of AUM. With others, it's 1 year. But as soon as we get to those places, we can have those conversations with the platforms and see where they stand. But I think it's going to be a lot more positive than where we're at with 2 times levered single stocks right now, which is, it's an absolutely non-starter for financial advisors. Not that they don't want to use them. It's just that they can't. RIAs can use anything, if it's on the Schwab platform or on the Fidelity platform or something else like that. But when it comes to the wires and it comes to certain independent broker dealers, they have limits on what they allow on their platforms. And right now, leverage is a non-starter regarding like the 2 times single stock leverage. This could be a game changer.
Gotcha.
Could I technically, let's say the Tesla one can go up to 9% capped. Let's say I buy it today, tomorrow Tesla has a 4.5% jump. It hits the cap on this one, right? It's the double X. It hits 8.9. Could I sell the ETF, take those gains, and then just buy regular Tesla and still have now 1x upside, 1x downside?
Yeah. So what I would say to you, though, in that regard is just make sure you look at our website and see what the return is, because as you know, with options, the closer you get to the strike date, the more it reflects the actual price. So you want to make sure that your options are priced appropriately. And so we have a rolling chart that's on the website, so you could see what those options are priced at, and then you can make that determination. But yes, if Tesla were to take a huge jump and you were to get really close to that strike price, you could potentially do that. Absolutely. It's daily liquid. You can make that determination and decide whether or not you want to take that return on the spot and then roll it into something else.
Okay, so I know we're not showing the website just yet today, but people are listening to us. what exactly should they be looking at on the website to make those decisions?
So today you're going to see it in graphs, but we're going to have a rolling chart that's coming out. And we, like with everything else with this, we have to go through like excruciating compliance reviews and FINRA reviews. And so we wanted to make sure that as we go step by step, we're representing it the proper way. So what they're going to be able to do ultimately is they're going to see a chart that will see the actual monthly cap rate, right? And that will stay static, because if you stay in it from point to point, you're going to, be able to realize that cap rate depending upon what the underlying performance of the stock is, right? But then on a day-to-day basis, what you're going to be able to do is you're going to see another line, and you're going to be able to hover over that. And then it's going to tell you where the option is today, what the price is today. And then you're also going to be able to see what the targeted cap for the rest of the month is. And so that will be able to help you determine that. But again, just like any other options contract, the closer you get to it, the better it is. So you could potentially see if something falls, because you're not at the end of that month, you could see that it looks a little bit different than the actual loss. And then you could see on the upside that you're not quite at that exact number percentage of return, because you're not at, towards the end of the month. But you could still see what the value of your holding is in the ETF, and you can make that determination about whether or not you want to get in or out.
Understood. Yeah, go for it, Evan.
No, you go for it.
I was just going to say, it seems like there's the biggest trend that I've seen lately in ETFs for retail investors specifically are them utilizing ETFs that are having experts create option strategies. And you see it pretty heavy right now on the income side with selling of covered calls. The leverage side is not options, it's usually swaps, but I think the concept stands there. And now you're seeing it with what you guys are doing here, which is basically, is this essentially like spreads on these pieces a little bit that are being created, or people are just going to keep coming out with option strategies? It seems like. Why do you think this is so appealing to retail investors?
Well, again, like I said, I think there's risk management built into a potential for an amplified return. And I don't think the average retail investor understands how to compose a structured note on their own or use option strategies for risk mitigation. And so all this really is experts that are wrapping it into an ETF wrapper. I mean, I think the beauty of the ETF is it's so much more than what it started out as. And it's this wrapper that gives you a ton of flexibility inside of it that you can use on a daily basis to trade in and out of, get the exposure that you want. So you're seeing lots of different things change. I mean, think about where we are today versus where we were 12 months ago. I mean, you've got, spot Bitcoin ETFs, right? Before, for a lot of people, it was the thought of having to go out onto an exchange, buy a Bitcoin, maybe take it off, save it outside, remember your password, because if you lose it, like it's gone, like all this stuff, like that was, tough for a lot of individual investors to think about. But now you have spot Bitcoin ETFs where you can literally buy the ETF, get the exposure to it, get out. It's a comfortability factor. So anything could happen inside of the ETF. And I think what you're seeing is issuers like us come out and saying, you know what, we're not plain vanilla anymore. We're not going to compete with, our goal at Dean's ETFs is not to list the cheapest broad index in the S&P 500 and trying to compete with, BlackRock or Vanguard or, State Street. Like, we're not going to do that. We would be dead in the water if we did. Right. So we've got to be innovative, and we've got to, develop products that help level the playing field for the growing retail investor that wants to do it themselves, but doesn't have the expertise to do it on their own. And so what we're creating is differentiated products that use, options and various different things to either try to generate income or try to generate an amplified return, protect risk on the downside. And that's exactly what you're seeing right now. You're seeing that kind of innovation enter into the marketplace, and firms like ours are committed to it, to being differentiated and to offering strategies that retail investors can use to level the playing field with advisors. I say it all the time, even on our leverage products, because, when they first came out and we were talking about them, not just at my firm, but, in my history in this industry, you get a lot of people that would say, aren't these too risky? Like, how could you offer leverage? I'm like, leverage exists. Leverage exists in the marketplace. Like, people have been using leverage for a long, long time. People have been shorting positions for a long, long time. All we're doing is telling you, like, don't worry about a margin call. Don't worry about pricing the options. Like, leave that to the experts. What we're going to do is take care of that for you. We'll be fully transparent. We'll disclose everything in our prospectus. Make sure you read the prospectus. And if we're offering you that kind of expertise that you want, that you always wanted to add to your portfolio, but you were scared to do on your own, or you didn't want to have to worry about margin calls or pricing the options, so on and so forth, we're going to do it for you. And you're going to be able to trade it in a daily liquid ETF. And I think that's why people are receptive to these strategies, because they see the advantage.
We got a question from the audience.
Sure.
I think it is similar in line with what I was talking about, but their thought is more trading this. And it's an interesting idea. So they're saying, can you buy and sell mid-month and lock back in the same cap rate? And I guess my thought of that is they're thinking like, hey, you know, I buy Tesla, it pops, we hit the cap, I sell. Tesla, you know, let's say goes back down, right? So now we're out of the cap territory. Can I buy back in again? You know, and write that back up, like basically using it as a trading vehicle.
Yeah, so the total remaining cap rate changes on a day-to-day basis. That's why I said, you know, at the beginning of the month, it's going to be priced out if you're in it for the month. Doesn't mean that you can't get back into it, but what you'd have to do is, again, go to the website, look at that rolling chart that I talked to you. It's going to tell you what the targeted cap rate is from that day. So that's why when you look at these cap rates that you see today, we're launching them. We're okay with them. We're not like super worried about where they are today, because when you launch something, it's about perfecting it from the launch date and getting it all down. But again, I'm also curious to see what the cap rates are going to be like at the end of the month, because I think that they're going to be vastly different from what you see today.
Sure.
So if you trade out of it in the middle of the month and then you get back in, you just have to go to the website, make sure you check what the total cap for the target cap from that point forward for the rest of the month is. And that's the rate that you would get.
Yeah, good question. Appreciate that, James. If anyone else in the audience has questions, feel free to drop them into the live stream chat, and I'll try to pull a couple. I had one other question, because this to me, you know, we're getting a little wild here in this world of ETFs. I was just curious, Paul, you've seen a lot of ETFs. What's maybe it's one of your ETFs, maybe it's another ETF. What's an ETF where you saw it and you're like, wow, like that's a crazy concept. I can't believe they're doing that in ETFs now.
You know, it's hard for me to even think about that, because I've been in the investment space way longer than I've been in the ETF space. And so, like, to me, again, I think there's a reason for every kind of investment. And if it's suitable to you, then it works. So I don't think that there's anything crazy. I think we're just at a great inflection point in the industry right now, where we're getting to work with the regulators so that they understand that, you know, you don't have to be an unbelievable expert to be able to invest in certain things like private markets or private equity or in Bitcoin or in other cryptos. And they're allowing people to have choice. So I think the greatest innovation is that we have a regulatory system that is beginning to understand the needs of investors. And the greatest innovation that I could say in sort of my investment lifetime is that ETF wrapper. And so when I started out on the mutual fund side, like everybody else, 20 something years ago, 25, 26 years ago. And, I even struggled with, like, why would I want to get into this mutual fund? Like, for retirement plans, it's good. You put money in, you dollar cost average, it's great. But, when I started, there was like C shares and you had upfront charges and all this stuff. And I was like, man, why do I want to get into
low
this
charges?
Yeah. I mean, I was like, this thing sounds terrible for a personal investment. Why wouldn't I just buy and sell the stocks? But ETFs are completely different. You removed a lot of those fees. And so it's the ETF wrapper that I think is the most innovative thing that has happened. And the fact that it has grown so quickly, gotten so much attention, that people understand it better. And with that wrapper, the investments have always been around. And I don't think anything is super crazy. I think that sometimes people go a little bit overboard with the marketing. I'm not going to mention names, but it's hard to not mention, but some things are so juiced up and the marketing is so juiced up, and it could get a little bit crazy. But again, what I would just say to people is, look at the underlying, holdings in the ETF and make sure that you're comfortable with it, and understand that, if as much risk as you're taking to the upside, a lot of times you're taking that to the downside. And that's what we were trying to do with these, is like, let people know, like, yeah, you're going to get an opportunity on the upside for an amplified return, but we'll limit your risk, and make sure that you're not taking on more than you can handle. So that would be it. I think the ETF is the innovation.
Now, how do you
Can I
cap my
ask you something on
downside?
that?
Yeah,
No.
yeah.
I want to, on like the most extreme scenarios, like what ends up happening here? Is there like a back testing thing where, hey, if it's down 50% in a month or something, it's broken? Like, I'm just curious on what we're going through, like the most extreme scenarios.
Yeah, you don't really break on this like the way that you could. So like essentially with a 2x levered ETF, right? You could get broken, right? You could get broken. So if you're 50% down in a day, that's 100% loss in the down day. That sucks for that guy that got in, right? So you could lose, but that's not the same with this because what you're risking, you're always risking your entire position, right? Because if a stock goes down 100%, you'll be at zero. So that's the risk. The risk is the same as entering into a security. If I put $100,000 into Tesla today, right, and something blows up, right? Elon Musk goes up into space and he gets lost in the universe and he never comes back to orbit. And Tesla goes from where it is today to zero. I lose my entire investment, right? But with a 2x leverage, just the single stocks, if you lose 50%, that's 100%, right? So the risk that you're taking in these capped accelerated funds is just the risk of investing in that security like you would any other thing, right? It's just the upside is a little bit more beneficial in certain months where you believe that the cap rate gives you enough room to grow and gives you enough room for an amplified return. And that's the benefit. So there's not, and again, like you asked me what could break, I anything could break on any given day if you're not with the right manager, but we have a lot of confidence in our portfolio management team. They're very highly experienced. So I wouldn't want to say that nothing could ever break. I can't make any guarantees, but like we're really happy with the team that we have in place. We think they do a good job of managing the strategies and we're very comfortable there. And we of course have, so many different things that the portfolio management team puts in place from a trading perspective to make sure that things are operating, effectively. And that's part of, the responsibility that we have as portfolio managers. We take our fiduciary, all our management responsibilities very seriously. And we have things that are in place to make sure that things don't break. And if something were to ever, we would immediately respond to it and communicate to that. But that's every asset manager. You have to have those things in place.
Good questions, Evan. Any other questions on the 2x capped accelerated ETFs from you?
I definitely do have a couple more. There's a couple like selfish ones that we kind of play in this space. So I would be thinking around like the branding of it and that whole aspect of it. And that seems like for some people don't think that's going to be the determinant for a lot of ETFs, but for a strategy like this, you have to educate people. Like this could be the best thing ever, but if they can't understand it, they're not. It's not just so simple as this. So to imagine there was a lot of. As my headphones die, so I probably sound a lot different. I'd imagine there was a lot of thought and effort in how you're getting this across.
Yeah, and there is, and we're talking about them a lot, and we're building those materials as we go. On October 27th, we're going to be at the opening bell, ringing the opening bell at the SIBO in Chicago, and that's who we. So we're going to be talking a lot about these strategies. They help us manage the strategies. So like we're going to be talking about them. We'll be doing videos. That's part of our whole marketing strategy. So like even on the single stock leverage side, we do videos. We do videos on our thematic and sector-based ETFs, to get people to understand how still in this day and age, people don't understand how fees impact strategies. So yeah, we're in the process of creating all of those materials, distributing all of those materials through our partnerships, and making sure that we are getting the message out through all of the various channels, exactly, what we need to do to educate people on these strategies. And again, I think that's why there could be some uptick in the advisor community. I know that there's several advisors that have reached out. I also manage a team of people who market and sell directly to financial advisors in the US. And so we've already gotten inquiries about it, like how do these work? Where are they available? How can we put them into our portfolios? So on and so forth. And again, we don't say it's a replacement for any security. Like, if you own the stock, that's great. We're not trying to tell everybody, hey, sell all your NVIDIA and jump into this. But what we're trying to talk to them about is like how they might manage this with a cap rate on a month-to-month basis, how they might think about this if they want to gain additional exposure around earnings, but they're concerned about taking like a 2 times maximum loss if they were to get into one of our leverage strategies. Because advisors, believe it or not, the RIAs can use it, but you'd be amazed at how interested they are for their own personal accounts to use our leverage strategies and some of these capped accelerated things.
And then I want to ask another question, kind of a little bit more. Why 1 month? There's a bunch of different strikes here. Is there something we found with that? Is it just testing out? Were you about to find the weekly one? I was also even kind of going out. I wonder how the strategy does on a quarterly basis.
Yeah, so there's no determination of what the monthly be. This is how we worked it out. And while I'm not a product manager or a product developer, we do talk about product all the time. It doesn't mean that this is where it's stuck. This is where we were comfortable with the option strategies, where we thought the cap rates would settle best, so on and so forth. But absolutely, like, could you see weekly down the road? Sure. Could you see quarterly down the road? Sure. This is the start of something new. And like everything else, once it's implemented and we get our arms around it, we'll be able to see. I mean, like if you look at the buffered space, not in single stocks, but in other types of strategies, you see yearly, right? But, the yearly ones for us, we think that's like a long time for somebody to be locked in, especially for the cap. And again, based on the options, how they're priced and the volatility, we thought monthly was the right cadence for these. But you never know. We've had some initial discussions about potential time periods, and you talked about marketing, right? And how we develop our marketing and our fact sheets. Like we've talked about like how we might structure that if we were one day to change the investment periods. But for right now, we have an expression, especially when we're doing something new: crawl, walk, run. Right now we're crawling. We'll get to a walk pretty quickly, and then who knows where we start running to.
Yeah, this question doesn't really impact you that much at this point, but it does on one of them for 1 cent. What happens with dividends?
The dividend
On the
like
you don't really get it because it's options.
Yeah, like I think the dividends, just like anything else, will be stated and rolled into it, and I'll get back to you with the question of that. But generally speaking, if there are dividends that are in the stock, we incorporate them, and then there's some kind of dividend yield that's appropriate. But I'll actually, no one's asked that question, so whoever asked that question, kudos to you, and I'll get back to you with that from the team. But generally, they're just incorporated in and they're paid out.
Nice. Original questions here.
I love it. I love it. You guys are challenging me.
25 minutes into
to day 2, and I'm getting
no, this
challenged.
Is awesome. So, but yeah, I think the big point here though is that these are a new concept, not a new concept in general, but a new concept in this ETF space, maybe towards retail in general. And I think a lot of people are going in and kind of trying to understand it a little bit. I want to get some of my options friends and just actually like dig in on the page and look at the contracts too. So I'm probably going to go in and circle in and do that myself.
Yeah, and so for that,
I might have bought.
And so for that, we want to have our PMs on. I think we've talked about that, but I'd love to have those guys on because they can talk way deeper into the options contracts and how they work and all that stuff. And we were going to potentially do it on this, but I think they're very busy and they're very focused on the launch and making sure that everything is operating properly. Having all that risk management in place that we talked about. So I wanted to give them the time to really work on this and get it locked down. And then, potentially we can have them on something else later on.
My guess for what are going to be the most popular too, NVDO, for just NVIDIA, everything just ends up working. And then I think the Coinbase one.
You do.
Is going to surprise everyone and be number 2. I think Coinbase... maybe it's Tesla, maybe it's Palantir, maybe it's MicroStrategy, I don't know. But COIO, Coinbase ones, I feel like there's an underrated interest in that area.
It has the highest cap right now, target cap right now, mid-month at 12.62. And again, I think what you're going to see is the more volatility that's created and the higher the caps, I think that will strike a lot of interest. Even on a personal level, it strikes me, because if I could have the ability to get into something and get it 2 times up to like I said, if you ever get to like a 39% or a 40%, that sounds amazing to me. So
Oh, I need you to fast track one for me. I'm telling you, a United Health one, the people would love
all
it.
right.
I have no idea how it would actually do, but I'm telling you, they are the crowd is yearning for some UNH plays.
Everything is being looked at, and that's been such a great play for us on the 2x leverage side. And just going back to the conversation that we had last week on one of the streams, it's pretty amazing. You know, somebody predicted that it should start to creep up, and it gets to the 260 mark. That might be an interesting place to get in. We're seeing incredible flows, and I think it did get to the 260 mark. So it'll be cool to see whether or not they actually started to dig into our strategy. But yeah, I agree with you. UNH is an interesting one. UNHG, which is our single stock 2x levered daily, has done really, really well. And our firm is growing light speed right now. So it's been really remarkable.
I thought that first week when you guys launched right before the earnings or right after the earnings, it was right before the earnings, and United Health stock's going down, but I was watching the AUM and it's just going up, and I'm like, all right, they are interested in this one. You hit the right spot, and then obviously now it started to do a little better.
Yeah, and you never know. Like, you just never know with these things. Like, there's always apprehension when it comes out to see what the lift is going to be. And obviously, as the chief revenue officer, you know, we're looking at how quickly we could build AUM so we could level out and get to our cost basis and things like that. And so, you know, this was I wouldn't even call it a home run. I'd call it a grand slam. And we did really well. And sometimes you hit the nail right on the head. And we did that with UNH. And we're always glad when we can build a product, provide it to the investor community, and it's received well, because it means that, you know, we're doing our job, continuing to innovate and give, you know, the investors what they want. You know, we never, like I said, I've been on this stuff a couple of times already, and you know, people ask me what I think. I'm like, what I think doesn't matter. You know, like, I have my opinions and I'll share them at times, but that's not my role here. If you want to come sit with me in a backyard, crack a beer or have a glass of wine, I'll give you all the opinions you want. My kids will tell you that I have too many opinions, but at the end of the day, we want to provide products to investors that, again, help level the playing field for retail investors with institutional investors, help institutional investors get the ease and use of a daily ETF so they can get in and out of it and use it as they like, and then ultimately provide market exposure or strategies that you wouldn't be able to do on your own because you're not expert enough to do in an easy to use daily liquid ETF wrapper. So yeah, we're really pleased with UNH. It's a compelling story right now. And I think it's a good story. So really glad to see that it's doing well. And we're getting, you know, our volumes are increasing across all of our 2x levered ETFs. They're doing great. So
really good stuff. This hour flew by. We are going to pick back up here in about an hour at 4 p.m. Eastern on Spaces. So we'll be back there. We're going to talk a little bit about these, and then also talk about the new double leverage ETFs that were released earlier this week as well. So there's a lot to go over. Paul, really appreciate you spending the hour with us. Any final comments you want to share with the audience on this one?
No, I just do your due diligence to dig in. And like I said, just keep up to date on the month-to-month caps. And we just really appreciate being on the show, getting involved with your community. It's an awesome community. Like, all of us have dug in, and we really like the audience, the people that are on, how intense they are about trading and investing. Like, that energizes me. So we just really love being associated with you guys and talking to you guys. And I think the conversation is great. So thank you very much. And thank you for everybody who's on listening.
Love it. Thanks so much, Paul. Evan, any comments from you?
Nope. I appreciate everyone. Obviously, if you guys are doing your research and have any questions, reach out to us, reach out to anyone here. You know, we'll get back to it, and we'll ask it on the next show we do. So we appreciate everyone.
Yeah, drop us any questions. Next show, like we said, in an hour, it's going to be hosted on Wolf Trading on Spaces. So we're looking forward to see everyone then. Thank you for tuning into this live stream. This will turn into a recording as soon as we finish. You can go back and listen from the beginning in case you missed anything. We were pretty extensive. We'll see you on the next one. Take care, everybody.
Thanks so much, guys.